Hey everyone, and welcome back to the channel. Have you ever dreamed of owning a piece of Hong Kong's iconic real estate but thought it was out of reach? Well, today we are diving deep into a fascinating corner of the investment world that might just make that dream a little more tangible: Hong Kong REITs. We are going to uncover the top 5 undervalued Hong Kong REITs, that's real estate investment trusts, and break down their financial health, what their future looks like, the latest buzz, and what the pros are saying. Stick around because this could be where opportunity meets value. If you haven't already subscribed to our channel, please subscribe to our channel. Your support truly makes a difference, enabling us to produce more stock and fundamental analysis content. But first, a quick disclaimer. Please note that the content presented in this video is for informational purposes only and does not constitute investment advice. We strongly recommend that you seek proper guidance from a qualified financial advisor before making any investment decisions. What exactly is a REIT? Think of it like a mutual fund, but instead of investing in a basket of stocks, it invests in a portfolio of income-generating properties, things like office buildings, shopping malls, hotels, and even industrial warehouses. When you buy a unit in a REIT, you are essentially buying a tiny slice of these properties. The cool thing about REITs is that they're legally required to pay out a big chunk of their taxable income, usually at least 90% as dividends to you, the unit holder. This makes them super attractive if you're looking for a steady income stream. Plus, unlike directly owning property, REITs are publicly traded, so you can buy and sell them just like regular stocks. So why are we focusing on undervalued REITs? Well, it's all about finding a bargain. We look for REITs whose market price seems lower than what their actual assets are worth. We do this by comparing their market price to something called their net asset value and their price-to-book ratio. Think of NAV as the estimated market value of all their properties minus their debts. If a REIT's market price is significantly below its NAV, or if its PB ratio is low, it could mean the market isn't fully appreciating its true value. We also check their dividend yield compared to others in the market. It's like finding a designer bag at a thrift store price. After sifting through the data, we've identified 5 Hong Kong REITs that show promising signs of undervaluation. Now let's break down each one. First up, USU REIT. This REIT primarily owns commercial properties in mainland China, especially in big cities like Guangzhou and Shanghai. Their portfolio is quite diverse, including offices, retail spaces, hotels, and even serviced apartments. Financially, 2024 saw their operating revenue dip slightly and their distribution pay unit, or DPU, also decreased. However, they've been smart about managing their debt, reducing their foreign currency and floating rate debt, which helps lower their borrowing costs. Their occupancy rate is around 84.5%. Now here's the interesting part. Their price-to-book ratio is a low 0.28, meaning they're trading at a big discount to their asset value. Their dividend yield is attractive at nearly 8%. Looking ahead, they're actively converting vacant office spaces into smaller, more leasable units, and this is showing good results. Potential interest rate cuts in China and the US could also help them save on financing costs. Plus, there's buzz about a REIT Connect scheme that could bring in more investors from mainland China. However, the China office market is still tough, with a lot of new supply expected. What are people saying? Analysts generally have a buy rating, with an average price target suggesting a potential upside of over 10%. But some warn that their interest payments and dividends aren't fully covered by their earnings, and one source even calls it a value trap. So it's a mixed bag, highlighting the need for careful consideration. Next, we have Sunlight REIT. Sunlight REIT manages a mix of 11 office and 6 retail properties right here in Hong Kong. Their retail properties, especially those near border crossings, are a big part of their income. For the 18 months ending December 2024, their revenue and net property income were solid, but their overall occupancy saw a slight dip to 90.1%. They also experienced some negative rental adjustments. Their debt levels are manageable with a gearing ratio of 26.3%. Their future looks promising due to their diversified portfolio, which helps them weather different economic conditions. Their Grade B offices, which cater to smaller businesses, are less exposed to the broader office market slowdown. And again, the potential REIT Connect could be a big boost. Analyst sentiment is largely positive, with a buy consensus and a target price suggesting a modest upside. However, the recent declines in occupancy and rental adjustments are a concern, and their debt maturity period is relatively short at 1.4 years, which could mean refinancing risks. Moving on to Champion REIT. Champion REIT is a big name in Hong Kong, owning prime office and retail properties, most notably the Three Garden Road office complex and the Langham Place office tower and mall. In 2024, their total rental income and net property income both decreased, leading to a significant 15.5% drop in their distribution pay units. Their office occupancy was mixed, with Three Garden Road stable at 82.6%, but Langham Place office dropping to 87.2%. The good news is their Langham Place Mall is a star performer with nearly 100% occupancy. Their gearing ratio is healthy at 23.7%. The outlook for their office segment remains challenging due to oversupply. However, their prime grade A offices are well positioned for any future recovery in Hong Kong's business environment. The Langham Place Mall is expected to continue providing stable income. Here's where it gets interesting. Analyst sentiment is mostly sell with a negative price target, anticipating for DPU shrinkage. This contrasts with Simply Walton view that it's trading 53% below its fair value. This divergence shows the market's skepticism about the office sector's recovery, despite the REIT's strong retail asset. Next up, Prosperity REIT. Prosperity REIT has a diverse portfolio of 7 high-quality commercial properties in Hong Kong's decentralized business districts, including offices, commercial, and industrial properties. For 2024, their revenue and net property income saw a slight decrease and their DPU dropped by 15%. However, they maintained a strong occupancy rate of 94.2%. Their gearing ratio is stable at 25.1%, and they have no refinancing needs until 2025, which is a big plus for financial stability. Their future looks stable due to their strong balance sheet and diversified portfolio. They're also leaders in sustainability, having secured Hong Kong's first green and transition loan in real estate and achieving green certifications for their entire portfolio. This could attract more environmentally conscious investors. Analyst sentiment is generally buy, with the price target suggesting a decent upside. Simply Wall sees them as significantly undervalued. However, some investor comments show concern about recent dividend deductions. The key here is whether their DPU decline has bottomed out and if their strong occupancy and green initiatives can drive a re-rating. Finally, we have Fortune REIT. Fortune REIT focuses primarily on retail shopping malls across Hong Kong and Singapore. Their income mostly comes from rents and leases. In 2024, their revenue and net property income decreased, and their DPU also saw an 11.9% decline. Despite this, they maintained a very high occupancy rate of 95% and a strong tenant retention rate of 79%. Their gearing ratio is healthy at 25.6%. Fortune REIT has been proactive with asset enhancement initiatives, completing a major project at their flagship mall, Plus WOO, which should drive future growth. Like the others, the potential REIT Connect scheme is seen as a significant catalyst. analyst sentiment is overwhelmingly positive, with a strong buy consensus. Multiple investment banks maintain buy ratings. This strong confidence, despite recent income dips, is likely due to their robust operational metrics and strategic enhancements. So, what do all these REITs have in common? They're all trading at significant discounts to their net asset value, with price-to-book ratios ranging from 0.28 to 0.37. And they all offer attractive dividend yields from 6.55% to 8.74%. This suggests a potential bargain for long-term investors. However, most of them have seen a recent dip in their income and distributions, which is likely why they're undervalued right now. The office-heavy REITs like USO and Champion are facing tougher times due to oversupply. Meanwhile, retail-focused ones like Fortune and diversified ones like Sunlight tend to be more resilient. The core investment idea here is that these REITs are undervalued, offering a margin of safety. What could make their prices go up? First, lower interest rates. If interest rates continue to fall, it means cheaper borrowing costs for these REITs, which directly boosts their income and makes their dividends even more attractive. Second, the REIT Connect scheme. This is a big one. If Hong Kong REITs are included in the Stock Connect program, it would open them up to a huge pool of investors from mainland China, bringing in new money and potentially pushing up their valuations. And third, a recovery in the Hong Kong property market. As the economy stabilizes, we could see improved occupancy rates, higher rents, and an increase in property values, all of which directly benefit these REITs. Many of these REITs are also actively working to improve their properties and manage their finances smartly, which is crucial for long-term value creation. Now, it's crucial to talk about the risks. No investment is without them. On the macroeconomic front, a prolonged global economic slowdown could hurt demand for properties, impacting rental income. Interest rate volatility is also a concern. While cuts are anticipated, unexpected hikes could increase borrowing costs. Geopolitical tensions could also deter investment. For the sector itself, there's still a risk of a broader downturn in Hong Kong's property market, especially with the ongoing oversupply in the office sector. Changes in how people work and shop could also permanently alter demand for certain property types. And finally, company-specific risks. Some REITs like USO have higher debt levels, which makes them more vulnerable if income drops. Persistent declines in occupancy or rental rates directly hit profitability. And while management initiatives are positive, there's always a risk they might not deliver the expected benefits. Plus, for income investors, dividend sustainability is key, especially if distributable income keeps falling. So, to wrap it all up, Hong Kong REITs offer a unique opportunity to invest in real estate, often at a discount to their underlying asset values and with attractive dividend yields. While they face challenges, particularly in the office sector, proactive management and potential market catalysts like interest rate cuts and REIT Connect could unlock significant value. If you're considering investing, remember these key recommendations. Look for diversification, REITs with a mix of property types or a focus on resilient sectors like neighborhood retail might offer more stability. Keep an eye on interest rates. They directly impact a REIT's profitability. Dig into their debt, understand their debt structure and refinancing needs. Assess management strategies. Are they adapting to market changes? Consider the REIT Connect potential. This could be a game changer for the sector. And always do your own thorough due diligence beyond just the headline numbers. This isn't financial advice, but hopefully this deep dive gives you a clearer picture of the Hong Kong REIT market and some potential opportunities. If you found this video helpful, please hit that like button, subscribe for more in-depth analyses, and let me know in the comments below which REIT you're most interested in, or what other topics you'd like us to cover. Thanks for watching, and I'll see you in the next one.